Hello everybody, my name is Michael Quinn. I'm one of the directors of the Quinn Group. This month on Quintessential TV, we'll be discussing share investors being under increased scrutiny by the ATO for capital versus revenue classifications. When most taxpayers dispose of share investments, there is a tendency to automatically assume that any taxation implications will be dealt with under the capital gains tax regime. This means that taxpayers normally expect all or at least part of their gains to be sheltered under the various CGT concessions, such as the general CGT discount and any other eligible CGT rollovers. The recent Administrative Appeals Tribunal and associated federal court decisions in Ransley act as a reminder that taxpayers cannot always safely assume the general CGT discount applies when shares have been held for at least 12 months. Conversely, in the recent federal court decision in Gregg, it was held that taxpayers' losses from share transactions were not deductible on revenue account. This was primarily on the basis the federal court did not form a view that the underlying share transactions were of a kind contemplated by what is generally referred to as the Meyer Principle, meaning that losses were instead to be treated as capital losses. It is well established that where a taxpayer enters into an isolated business transaction with an intention to make a profit or gain, the profit or gain will be ordinary income under Section 6.5 of the Income Tax Assessment Act. This is the case even if the transaction is extraordinary when judged by reference to the ordinary course of the taxpayer's business. This differs to the CGT treatment afforded to the mere realisation of a capital asset, the taxation of which is dealt with under the CGT provisions. In other words, the Meyer Principle, established in Meyer's case, is the precedent that profits made on the realisation of an asset may constitute ordinary income if the asset was initially acquired either as part of a business or under a profit-making undertaking or scheme, with the intentional purpose that the asset be subsequently realised in order to capture the profit. For similar reasons, if a taxpayer in such circumstances makes a loss, the loss is deductible on revenue account under Section 8.1 of the Income Tax Assessment Act. The case here in point is Visy Packaging Holdings. According to the ATO, a loss from an isolated transaction will be treated on revenue account where a taxpayer has entered into a transaction intending or expecting at the time of the original acquisition to derive a profit which would have been assessed as assessable income, and the transaction was entered into and the loss was made by the taxpayer in the course of carrying on a business or in carrying out a business operation or commercial transaction. We will make a detailed fact sheet available in relation to this particular matter, and it will be available by emailing us at info@quinns.com.au. If you'd like to know more about the capital versus revenue classification for share transactions, please contact us. You're welcome to email us at info@quinns.com.au. We'd love to get your feedback with relation to Quintessential TV, so please like, comment and subscribe. We look forward to seeing you all again next month. I'm Michael Quinn. Bye for now.